DIRTT Environmental Solutions, is symbol DRT on the TSX, is a modular interior construction company that specializes in sustainable building solutions. In addition to prefabricated physical products like their walls and their doors, the company also offers its proprietary design integration software, or ICE, which helps people design their offices and build out with their products. The company operates in both the US and Canada, with the US being the lion's share of the revenue. The stock is trading at $1.18 a share and a $228 million market cap after a very strong performance over the last year, rising 107%. However, when we step back a bit, zooming out on the stock performance is just not being very good. You can see it's come up over the past year, but the stock is still trading very well off its all-time high set in 2019, and that was about $7.60. So you're looking at really a seventh of where they were 6-7 years ago. So why has the stock really performed so well over the past round? Is a turnaround now occurring in the company? So just pulling up a chart from the company's Q3 presentation, as it really shows the really major shift which they've seen over the past couple of years, and that's to do with gross margins. Gross margins have improved dramatically, with non-GAAP gross margins up at 40.7%, and that is all the way from 17.7% in Q1 2022. This is now similar to the 2019 levels at that 40%-ish level, and it was prior to 2019, it was in a similar mark as well. The improvement was largely driven by cost reduction measures that the company has taken over the past couple of years. The company closed a couple of facilities as well as lowered its headcount quite a bit, by about a quarter, from 2019 to 2023. This is really reflected across the business as a whole, and it has overall really pushed the company towards overall profitability, with the last quarter marking 4 consecutive quarters of GAAP profitability, but that does have a caveat in it, which I'll go into in a couple minutes. So moving on to the most recent financials for Q3 2024, the figures are in US dollars, even though it is trading on the TSX, the financials are in US dollars. So revenue fell by 12% year over year to $43.4 million due to 4 large projects occurring in Q3 2023 that did not reoccur. So it had a bit of an uptick last year, so it fell off this year. But overall, if you take those out, it's round flat. GAAP gross profit margin improved to 38% from 34.4%. But gross profit overall on a nominal basis fell slightly to $16.8 million from $17.1 million due to the lower revenue level. So improved margin, but lower revenue base. Adjusted EBITDA fell to $4.1 million from $5.3 million, as the EBITDA margin did fall to 9.4% from 10.6% due to that lower gross profit as well as higher operating expenses. So the company as a whole had reduced operating leverage on that lower revenue level, despite the improvements in those gross margins. So net income, however, did come in at $7.1 million or 3 cents per share. A big improvement from a loss of $6.3 million or a loss of 5 cents per share. This is really due, however, due to a gain on extinguishment of convertible debt, as DIRTT did buy back $32.5 million of face value of debentures during the quarter. Without the gain, the company would have been at a slight net loss, which does really take away from that consecutive GAAP profitability I mentioned before. But still, it's a big improvement, even if you do take away that extinguishment on debt. So shifting to the balance sheet, the company had a net debt position, including leases, of $31.7 million. Without the leases, DIRTT is at an ever so slight net position, but nothing meaningful, so effectively zero net debt. The level of net debt has been significantly reduced over the past years. The company repurchased outstanding debentures at the start of 2024. This was, however, they funded at the start of the year, and they just recently bought them back during the quarter. And they funded this through a rights offering and issued shares, which were then converted at 35 cents a share. So the balance sheet improved a lot at the cost of increasing share count by about 62%. So big increase in share count, but it vastly improved their balance sheet. That's your trade-off there, shifting from raising through debt to raising through equity. The trailing net debt and leases to EBITDA is at now 2.2 times, which is on the higher end, but that's effectively driven by the leases, as I said before. And it does seem now to be structurally sound, at least after repurchasing those debentures. I would say that's a bit high, but since it is in leases, and the debentures are actually only at 6.5%, which is cheaper than what you'd expect a company in distress. Some of those companies we see in distress when they're really leveraged up, that was at 13, 14, 15%. So the interest rate isn't excessive on what they're holding them at. Additionally, off the balance sheet, the company does have significant tax loss carryforwards in both the US and Canada, so the company will unlikely to be making actual cash tax payment in the coming years, which is a benefit when you do see these turnaround stories, as it gives them a bit more growth leeway. They can reinvest the capital at a higher rate because you're effectively saving 20% or so of cash because you aren't paying that cash tax. So looking forward for 2024, so that's just one quarter left, the company is guiding 165 million to 175 million revenue and 12 to 15 million in adjusted EBITDA, but they actually have guidance for 2025. The company is guiding 194 to 209 million revenue and 18 to 25 million in adjusted EBITDA. Off those midpoints, 2025 revenue is expected to grow by 18.5% and adjusted EBITDA by 59%. So big uptick in that adjusted EBITDA because once you get that revenue up, if they are able to keep the margins, you do start to get that economies of scale and it hits that bottom line. As well, DIRTT's 12-month pipeline at the end of Q3 sits at 255 million, which is slightly lower than the previous year, but they have said that they have a higher quality within their pipeline. And you may notice, why is their revenue guidance lower than their pipeline? Is because it's just quality leads. And this is why you always want to examine their pipeline or backlog, whatever the company may call it, because there can be differences in what they're actually expecting. Some will be firm contracts, and in this case, it's just leads. So on a valuation basis, using the company's guided midpoint EBITDA for 2025, the EV to adjusted EBITDA is at about 9 times, so not overtly cheap nor absurdly expensive at the current levels, given it is a recovery story at the current time, but it may have upside if you are able to execute it, if you are able to hit those targets, keep the margins, grow the revenue. You do have some room for upside, but then on the flip side, if you do see a reversal, which you do see in some of these recovery stories, it's not all green pastures once you get out of the really trenches. You do have some downside risk, to say the least. So concluding, DIRTT really has had a rough couple of years, but rebounded in 2024. The company restructured its balance sheet, making the debt level manageable. The margins have recovered, but now we really need to see, can they grow from top to bottom line to support any really appreciation in the stock? To do this, the company will even need to navigate the risks just that come along with the construction industry as a whole, including the cyclical nature of the material inflation, which really hurt them last time, as well as just the overall supply chain management, which could have elevated risk given the current tariff talks. Overall, though, we will continue to monitor the stock as it really needs to just execute on its targets. It needs to be able to pass through this transformation, but it does look like it's at least making good headway, and it's now a question of whether or not they can continue into a now growth story.
Yeah, I think it's a good summary. I think, I think it is, getting more interesting on the margin improvement. I guess it's always what when you're looking at investing, it's, you look at this company, but then you look at 10 or 20, 30, 50 other companies. And like over the course of this past year, we were able to invest in some companies that had a growing backlog, like record backlog growing, and a projection of growing that going forward, traded at these valuations or lower, significantly lower on a current trailing EPS basis. And again, had more certainty to their growth. It wasn't a pipeline, it was a more firm backlog. So, there is some things to like about what DRT is doing right now, but you're always comparing that to what are your other opportunities out there. And if you have more certainty in a backlog versus a pipeline, and it is growing and you're trading at lower multiples, I'm going to go with that company versus this company. So this is a company we monitor. If it flips to where we see a firm backlog and growth in that, and then, trading it relative to reasonable valuations, perhaps at that point it can become a buy. But again, one of the companies we monitor, at some point over the next 6 months, 6 years, that may become a company we could buy for clients. It's not there today.
Yeah, and I think that's something which a lot of people just overlook in general, is the downside risk, because when it doesn't happen, you just make out like a genius, even if you were investing it, but you could be taking on more risk than what you really took. And then we get that a lot, saying when you see with some of these speculative companies, when they go up, not saying even DIRTT's even overly speculative, but speculative companies in general go up, whatever, 100, 200%. And then it's just the risk didn't occur. And sometimes it still even exists. But you'll have people point out you are wrong, not recommending this, when there's that risk there, you just didn't have it occur.
Yeah, and if you're putting 10 of those type of companies when you have too much risk and it has to hit on all the targets that they're speculating on growing at that level over this period, then I'd rather have a company that has a firm. Yeah, I mean, it's hard to find, but you can have a firm backlog, low current multiples, growth outlook, good balance sheet. Like you can have all those things. It's probably one or two out of the 1,000 companies that you look at, but look at 1,000 and find those companies, and you're going to push aside many companies that have a good story, but they might not have most of the items you want to check off. That is a way to prevent having catastrophic errors in your portfolio. So, I mean, that's what we're
Yeah.
looking at.